Hello YouTube friends, and welcome to Grow Money Seeds, a channel about building wealth and managing your money. This is the second video of a 5-part series on technical indicators. In this video, we're going to look at one of the most popular indicators called a moving average. If used correctly, this is a great tool. However, there are also some shortfalls associated with this indicator. Right, let's talk about this. Before we start, let's look at the definition of a moving average. In statistics, a moving average is a calculation to analyze data points by creating a series of averages of different subsets of the full data set. What are the main types of moving averages? There are two main types of moving averages: a simple moving average and an exponential moving average. A simple moving average is calculated by taking equally weighted prices and dividing this by the number of prices in a set. Since this uses equally weighted prices, it can lag, which means it can be slow and fall behind when generating signals. An exponential moving average is calculated by taking the simple moving average and then calculating a multiplier. The multiplier means that the calculation is heavily weighted to more recent prices in the set and makes this moving average more responsive. This does not lag as much as a simple moving average. However, because it is faster, it can also lead to false signals as it's more sensitive to price movement. Therefore, if we compare the simple moving average, which is represented by the orange line, to the exponential moving average, which is represented by the green line, you will see that the main difference between the two is the speed at which they move. What are the best settings for a moving average? Common industry norms are the 9, 21, 50, 100, and the 200-day moving averages. These settings can easily be changed in most charting software. The shorter the time frame, the quicker a moving average will move, and the longer the time frame, the more it will lag. A well-known combination of moving averages is the 50-day and the 200-day moving average. When the 50-day moving average crosses over the 200-day moving average, this is known as the golden cross and may indicate the market is bullish and may move higher. If the 50-day moving average crosses below the 200-day moving average, then this is known as the death cross and may indicate the market is bearish and may move lower. The reality is that you can use any setting for your moving averages. However, if you are new to trading, it would be better to use the most commonly used moving averages because you will be able to see what the rest of the market is looking at. Why do we use moving averages? Moving averages help us to smooth out data, which filters out noise, and they're mainly used for determining trends. For example, if we plot a short-term 9-day moving average and a 50-day medium-term moving average and a 200-day long-term moving average, and all three of these are moving up, we would then say that a stock is trending up and it may be a good idea to buy into strength. Conversely, if they are all moving down, then a stock would be trending down and it may be a good idea to sell or go short. There's a saying in trading that says, "Let the trend be your friend." Trading with the trend is one of the main rules for being a successful trader, so don't try to trade against it. What are the problems with a moving average? The biggest problem with a moving average is that it is a lagging indicator. This means it uses past data to generate signals after a price has changed, and it cannot predict future events. Some traders will try to use a moving average crossover as a trading strategy. The idea here is to use a short-term moving average and a medium-term moving average. When the short-term crosses over the medium-term moving average, then this would signal a buy, and conversely, when the short-term crosses below the medium-term moving average, this would signal a sell. The problem using a moving average crossover strategy alone is it will only give you a signal once an event has taken place. This indicator also does not work well in ranging markets and will battle to give you a reliable signal or define a trend. In summary, moving averages are lagging indicators and are mainly used for defining a trend. It is up to you what settings you use and whether you use a simple or an exponential moving average. Just remember to always paper trade with any new indicator or strategy before committing any real money. So, what moving averages do you use when trading? It'd be great to know your thoughts in the comment section below. Please also don't forget to click the subscribe and the like buttons if you have enjoyed this video, and your support would be much appreciated. Thanks for watching, and I'll see you in the next video.